Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by Zach Senior Strategist Kevin Cook to celebrate because this is the 200th episode of the Market Edge podcast. 4 years of doing this podcast, and we're still here. Thanks to everybody who's been listening, even if you just joined us, or maybe you've been here all 4 years. That would be amazing if you have been. But it's been a fun ride so far, and we are hoping for, another 4 years or more going forward here. But I wanted to, cover something special on this episode because it is the 200th episode. And so I asked Kevin to join me because I wanted to talk about what are our favorite, basically investing lessons or investing advice that we've gotten over the years. Kevin and I have both been investing for a couple of decades now. We've been around for a while, and we've both made mistakes along the way. We've learned from it. We've seen plunges in the stock market, recessions, all of this stuff going on. And so I thought this would be a good time to share some of what our experiences have been and what we've learned from it, and hopefully to pass that along to everybody who's an investor out there. So welcome, Kevin.
Thanks for having me.
Yeah, this is exciting. 200 episodes.
Congratulations.
Yeah.
That is, you have been so dedicated to this. You kind of knew that the people who were successful with podcasts out there were the ones who were consistent.
Yeah.
Just keep cranking it out, and then that's how you build an audience.
Yeah.
And it's working for you.
Yeah. And I think it also helps that we're giving some, good information out there about what's happening in the stock market and with the economy and all of that stuff.
Yeah,
that
every time I do a show with you, it's always interesting. It's not like listening to the news or some podcast that dredges up the same politics over and over again. We're always talking about some new angle, or fresh way of looking at the market, investing, psychology.
Yeah. So let's get right to it. I feel, should we start with you, Kevin, about what your investing lessons are?
Yeah. So when you said investing lessons, I thought, I could write down like 12 rules that investors should follow.
Right.
But I thought to make it more interesting, I wanted to come at it a different way, and then that I think will be more memorable too. So I came up with 4 themes that I want people to write these themes down and then go back to them. Like if you're ever, you don't like write it down somewhere, and you can ignore them, but go back to them at some point, whether it's a few months from now or even a few years from now, because they will stand the test of time.
Okay.
So, and I'm going to give you the quick names for my 4 themes right off.
Okay.
They are Buffett, trends, planning, and ETFs.
Okay.
And so I'll just jump right into Buffett. So we know who Warren Buffett is and why, and most of us have some idea of why he's a great investor. But again, your show here attracts people who are, you may have retirees listening, who have a different sort of investment outlook or plan. Right. And then you have people who are active investors and traders. Yeah. You might have people in their 20s just getting started. So
for sure.
But any of us can take a look at what Warren Buffett has done. What he's done well, successfully, is he just buys companies that he wants to own forever. Right. People ask him, what's your time horizon? Well, forever. When I buy a company, whether it's Coca-Cola or whatever. And he just tries to buy a good business that he likes the cash flows on, and he thinks that those cash flows are going to be returned to him over time.
Right.
So whenever you get confused about the market, whether it's because of what some economist is saying on TV, or somebody's talking about recession, or somebody's recommending, stay away from this sector industry, you can always go back to Buffett and just as a model of somebody who just has focused on buying good businesses.
Right.
Now, but it's not that he doesn't make mistakes, and there he's a model too, is he'll be the first to tell you mistakes he's made.
He definitely has.
And
I just did a podcast on the Value Investor about buying the banks that Warren Buffett's Berkshire Hathaway portfolio owns. And I immediately got these tweets back at me of like, oh, Buffett, he's made all these mistakes. He bought IBM and then he sold it for a loss, which he did. And then they went on with a couple of the other mistakes he's made. And he doesn't deny any of that. Every single investor would make a mistake. Mm-hmm. No one is going to get it right all the time. But you hope to get it right more than you make the mistakes.
Yeah.
And he clearly has.
And I haven't looked at how he's done versus the market in the past 5 years. I think he was kind of flat, maybe underperforming the market.
He's been underperforming because of the financials.
Yeah. So, but just the big idea of picking, quality companies that have positive cash flows growing over time and whether or not they have a moat. I mean, like Coca-Cola, you can't say that Coca-Cola has a moat because look at all this, software options out there. But over time, it paid off for him.
He likes those brands though.
And regarding his mistakes, one of the big glaring one, you mentioned IBM, but was that he avoided technology for so long.
Yeah.
So he missed a big part of economic driving forces, which are also market driving forces, as technology has become such a big part of, say, the S&P 500. All right, so that's my first thing is you can always go back to Buffett and learn something.
Okay, but what about like the rest of his investment philosophy that he does have? Like he has bought what I consider to be the boring companies always, like the banks and insurance. I mean, basically, he has made most of his wealth off of insurance. Should I be buying insurance companies? Should I go down that route?
I mean, that's his, that's his sort of an area of expertise. First of all, he wants a margin of safety. So he's kind of a value guy at the core.
Right.
And, and the whole...
everybody needs insurance. That's how he views it.
Exactly.
Right?
So I'm not saying copy what he buys.
Okay.
What I'm saying is when you think about investing and you're teaching it to your children and your grandchildren, you want to have that long-term mentality.
Okay.
So there are things to be learned from him, not necessarily buy what he buys,
right?
But his approach to the market. And the two things that stand out, obviously, are what's his time horizon? Forever.
Right.
And does he ever talk about recessions?
No.
He looks past anything and says, if I'm going to own this company for 10, 20, 30 years, there's going to be recessions.
Right.
He knows that.
Yeah.
But he's looking at, what does a growing economy like ours, what does it need? Say insurance or soft drinks.
We buy insurance in recessions, that's for sure. Okay.
So that my first theme is kind of boring, but but there are so many lessons to be learned there for the long haul. Like you could go read Ray Dalio's book, and I don't think you're going to learn that much about investing.
Have you read it?
No.
It's huge, isn't it? Like 600 or 700 pages. I've thought about reading it, but then I'm like, I don't know.
And I'll tell you this: I don't even know how much he gets into his economic model, but Ray Dalio's economic model is actually kind of complex.
Okay. Maybe that's why it's like 700 pages.
Yeah, whereas Buffett just says, this is a business I like,
Yeah.
and I want to invest in this business for a long time. Simple.
Okay.
All right, let's hear some of your lessons.
Okay, so one of mine is to buy the best and not the second best.
Oh, okay.
So, and this is for buying the individual stocks. So I
hope you've got some examples.
Well, I do have a story. The second stock I ever bought, and I was in my early 20s, and I don't remember why I chose this one, but I decided to buy Kmart at the time. This is in like the early 90s. And instead of buying Walmart, which was becoming the leader in that field, like so in the early 90s, Sam Walton, I think, was still alive, or he had just died or something right around there. There was either a biography he wrote or a memoir or something that had come out. It was a best-selling book. Everybody hated Walmart in all of small town America because it was putting all these mom and pop type of stores out of business. And, Walmart, it's, awful and all this. And why I didn't buy Walmart, I don't know. But I bought the number 2 thinking like, this is just as good. And I ended up losing money on the stock, which I sold 5 or 6 years later. And instead, I don't know what would have happened if I had owned Walmart from the early 90s, but a lot better things than buying the Kmart. So I really learned a good lesson from that is to, when I'm trying to find a company in a certain industry, I do look now for those that are the leaders. There is a reason they're the leaders. And, why pick the second best if you have choices?
Well, I think the trap that some people have fallen into, and I know I have, is you're looking at the leader. Well, the leader's kind of overpriced.
Right, that does happen.
Whether on PE or price of sales. So you're like, oh, I'm going to buy this one because it's cheaper. But the growth momentum isn't there.
Right. So that was a real lesson for me. And of course, Walmart is still the leader, basically, and still out there. And Kmart, well, we won't talk about them. So number 2, trends you had.
Yeah. So
what does that mean?
So trends, I talk about this in several ways. In 2017, I wrote for Zacks Confidential, I wrote a special report called The Technology Supercycle. And while there were many arguments to be made about how semiconductors are still cyclical, and we could go into a recession here, I noticed 2 things that stood out to me that I really wanted answers for. And the 2 things were, why did it seem like all these new gadgets were making us more productive, whether it was a smartphone or a new tablet, tablets in hospitals, and the adjoining software. And our cars were better and more fuel efficient. There was like so much technology that seemed to make life better and more productive. And yet the government productivity numbers were just kind of inching along. Like, why isn't all this massive explosion of tools and technology, why isn't it reflected in government productivity numbers? And basically it's because the government is such a big spender and such a low producer that they just sort of distort the productivity numbers that the government publishes. Whereas if you looked individually, if you drill down into industries and sectors, you see that telecommunications, software, obviously, anything that's becoming more digital has super high productivity. What companies are able to do is just amazing. So that was the one question I had. And then the other one was, why is there no inflation? Well, because all this technology reduces the cost of everything.
Right.
Even if you take out Amazon, which reduces inflation because it basically destroys other businesses and lowers the cost to zero, for whatever it is, free shipping. That semiconductors, they get smaller, they get faster, they get cheaper. That's kind of it's kind of the Moore's law has been extended. That it used to be the Moore's law was that semiconductors would double in power and shrink by half every 18 months. I mean, that effect is sort of still going on. And then software applications and having mobile devices and Wi-Fi just makes everything cheaper and more productive. So that's why I said, regardless, even if the economy was headed towards a recession, we are still in this big upward swing with technology, and it's just going to keep going. So those are the trends that I wanted people to focus on. And then, so that's kind of technology specific. But then here at Zacks, I also started a healthcare portfolio, Healthcare Innovators, where I identify the mega trends there, like an aging population needing more care, and then the explosion of science. So those 2 areas alone, healthcare and technology. I mean, there are books being written about the singularity. Like, when do we get to the point where a computer can think like a human brain, or they merge? That stuff is coming 30, 40, 50 years from now, as well as gene editing. So this stuff is changing the world so fast. It's created a pace of change that I don't think people are used to. So if you look at those trends, you want to somehow be invested in them.
But how do I do that?
Exactly. Even if you can't pick the stocks. I
feel overwhelmed already.
Yeah. Well, when I was I'll tell you about a time I was overwhelmed.
Okay.
I was overwhelmed in March of 2009. And for anybody
Okay.
who's been an investor around for a
That's
while.
not a good date.
Yeah. Yeah. And in March of 2009, I was actually working for a firm who asked me to go on television for them. I had done some
Okay.
video work for them, but I was going to go on television and recommend stocks.
Which TV?
The channel was Fox Business.
Okay.
And
So I could have seen you. I would have turned it on during the worst.
Yeah,
of
it was
the
actually
crash.
the week that the market bottomed, but nobody knew that at the time, right?
Wow.
That was the market bottom, the week of March 9th. And the producer said, you have to come with stock picks.
Okay.
I'm like, okay, great. The market's melting down again.
Well, this is a lesson right there.
Yeah. And this was after all the government measures, whether it was TARP or whatever to bail out the banks, and Warren Buffett was buying.
They had bailed out the autos by then.
Warren Buffett was buying the banks, and they were still going down.
Yeah.
Right. And so you were like, what? And so I said, you know what? I'm not going to recommend specific stocks. I said, I'll give you 2 things to buy today that I'm completely confident will be higher, and they were ETFs.
Okay.
And one was the XLK, which is the technology sector, and the other was the NASDAQ Biotechnology Index. The symbol there is IBB,
Okay.
which is the ETF that represents the NASDAQ Biotechnology Index. And I said, I'm confident that these things will be higher. Maybe I can't tell you where they'll be 2 months from now, but I think 2 years from now they'll be higher, and 20 years from now they're going to be a lot higher.
Okay, so if I had seen you on Fox Business that day, I use March 9th, 2009 as an example because I did look this up because you mentioned this before we started recording the podcast. And if I had seen you and decided, okay, I'm following his advice, I'm going all in on these 2 ETFs, the XLK now just over 10 years later is up 392% versus 251% for the S&P 500. And because it mimics the tech area, it's just equal to what the NASDAQ has done in that time too, which is up 392% as well. And then I looked up the IBB, that's the biotech one, and that one is also up 391%. So
wow, they're that close.
Yeah, so almost the same. But the IBB, and I do remember this from a couple of years ago, that was super hot out of the lows and soared by 2015. It was up 484% there by 2015 before it now has come back down and is now kind of moving sideways.
We had a little bit of a bubble there.
Yes,
The
yes,
biotech
a lot
bubble.
of people said that. So, well, this is a good question. What do you think of the IBB now that it's been moving sideways for 4 years?
Yeah, I mean, to buy it for the long term, for sure.
Okay.
For sure, you want to own it for the long term. So now is a great time, and I pick stocks within it. And I want to back up here a second. So we talked about Buffett, and then I talked about trends in ETFs. The thing I left out was, if studying companies like Warren Buffett does, or like you and I do. We study a company, we learn all we can about it, we listen to conference calls, we read articles, we go on the company website and look at their presentations, we read analyst reports. We dive in and we want to understand the business, whether it's like a company that I've studied a lot lately is Square. And
they're going to be reporting.
Yeah, they report tomorrow, and how they serve small businesses. I think that's sort of a revolution, but Wall Street is really soured on the stock because they think that everything Square's doing is going to be copied. And I've kind of differed. I thought, well, I think once Square, it's an ecosystem, and once a small business owner opts into that ecosystem, I don't think they'll leave. Now, I could be wrong, but still, I spend my time getting to know the company, or NVIDIA that makes the artificial intelligence chips, or CRISPR. But if you don't love the homework of getting to know a company, then picking stocks really isn't for you. And so you should do something like the simplest way to invest is just be invested in the S&P 500, buy an index fund or a mutual fund.
Yeah.
But what we just showed you here with, when you get sector specific and you want to buy long-term megatrends like technology, XLK, or biotech, IBB, then you can actually outperform the S&P 500,
right? Because
you've capitalized on a big trend.
So does this go to your number 4 ETFs? Are we kind of talking about that at the moment?
No,
do we come back to that?
We'll come back to that.
Okay.
Yeah.
All right.
I'll dive in a little deeper.
Okay. So my next lesson is you don't have to buy IPOs. I feel like I get this tweeted at me all the time. Like I have to buy it and I have to buy it right when it launches or else I'm going to miss out.
Yeah, it's going to go up 10 times.
Yeah, it's going to be the next Amazon. I could have been a millionaire if only I had bought it. And I feel like bringing up Buffett again, a good example of why you don't have to buy IPOs, at least not immediately when it launches, is Berkshire Hathaway. They recently just bought Amazon shares, and it's over 20 years later. Yeah. It went IPO 20 years ago, but yet they just got in it. And I feel like with these good types of companies, it's never too late. I mean, look at McDonald's.
And Apple. He bought Apple.
Yes, that was after that IPO.
Finally, he brought in some younger people because there's got to be a succession, he's got to hand over the throne at some point. So he's brought in younger research analysts, and they've probably been needling him for a while. We really have to buy Apple. We should buy Amazon.
Yeah. Well, he didn't seem too pleased about the Amazon buy. He didn't really want to talk about it at the last shareholder meeting. Yeah, because of the price that they had to pay to get in on that one. He does love Apple, however, and they kept adding to that position while the shares were still cheap.
Amazon is perfect for him though because they have so much cash. Doesn't he have over $100 billion cash now in
Amazon?
No.
He
Buffett.
does.
Yeah,
yes, 128.
So he can't go around buying small companies.
No.
So Amazon's perfect for him.
Yeah, right. I've mentioned that many times on the podcast that he's kind of restricted to the big caps, but you could buy some of these smaller IPOs, years from now if when you do your homework and figure out what's going on with those businesses. You don't have to rush out to buy them, but everybody thinks they have to be in like IPOs. So that's one of my lessons. No, you do not have to buy it. Okay, so turning back to yours, planning.
Okay, planning is my third theme. When there's so much noise out there. Like if you watch CNBC for a few hours every day or a few times a week, you could actually come away a lot more confused because you're going to hear different types of investors with different time frames, different agendas, different conflicts, all telling you something. Macro analysts telling you, the recession is coming, whatever. And you have to make sure you come back to the theme of that you're planning for yourself. And there's many ways to go about that. You could set up a 5-year plan for your investing, but still modify it every quarter if you want to. And so, you're gonna try and answer questions like, okay, what's my savings rate? How much am I putting away? And what different buckets does it go into? Am I putting 50% in an index mutual fund? Am I putting some in an ETF? And then am I having a little bit on the side where I can be a stock picker if I want to? So those are all kinds of questions that you have to answer. And, what are your goals? Obviously, it's different for every age person, and in their time horizon.
Yeah.
And then there's nothing wrong with getting advice. There's a ton of good advice out there, and some of the better firms are creating online modules, where they walk you through, finding out where you are in your investing life stages,
right?
And help you make those kind of decisions. And you can sometimes work with an advisor who, there's no fee.
Right.
They're going to help you manage your money. That there's a time to have those kind of conversations. And so planning is so important when you get confused, and then you go back to your plan and say, okay, what am I trying to accomplish here? And again, you can change it every quarter if you want to, or once a year. But to know that you're in charge and that some things should be set and forget. Some things are, do I have an automatic payroll deduction that goes right into, that when I started doing that with a 401k in 1995, it was like revolutionary for me. It was like, wow, just look at all that grow. I just keep putting it away. I don't look at it. I don't think about it. And once it starts building, you don't want to touch it.
That's right.
One time I did, in 1997, when I bought my first house, I did borrow from it.
Okay.
But then I vowed never to do that again.
Right. We all learned this. Now, what did you think when we had the financial crisis and stocks kept going down, down, down? were you still putting into a 401k at that time?
Oh yeah.
Were you able to do it? Because I kept putting it in to mine as well. But after like 3 or 4 months of that devastation, I still kept putting it in. But I admitted this before on the podcast, I stopped putting it into stocks and I went only into all cash because literally every time I put money in, it was wiped out.
Yeah.
And so I just psychologically couldn't handle seeing that, even though I should know better.
When you say, was that going into an index fund?
Yes,
Okay.
just regular mutual funds. And so I still put it in, but I went into cash instead. I left everything else. I didn't sell anything. And then it was the bottom. That was basically in March of 2009 because I just psychologically couldn't handle it anymore.
Well,
but
one way that I sort of gave myself like I don't want to say an edge, but just a marker in time was that I was buying on the way down in 2008, and I had a chunk of cash, and I bought it like S&P 1200, thinking this thing's going to bottom soon at S&P 1200.
And what did it go to? 666. Wow.
So I looked at that 1200 and I go, this will be back. It's like, what's the worst I'm going to do here? Because
this is where the plan comes in too. If it's in like a retirement and your retirement isn't for 20 or 30 more years, I should hope it's going to be back to there eventually.
Right.
But it is hard to counter those psychological.
Well, and that brings
issues.
up a really good point that should almost always be a lesson. When you know your time horizon, when you know this is, you can call it 10-year money or 20-year money.
Yeah.
Then your stress level should reduce.
It should.
And you go, this is going to grow. The worst thing I can do is sell at the lows.
That's right.
And you and I have talked about this before when the market was really volatile. We've done some podcasts where I'm like, okay, you just have to have a plan. If the market is in a big correction here, if you have a plan for, I'm comfortable with what I own now, and you make a wish list of all the stuff you want to buy on the lows, then you sleep at night while other people are going, oh my gosh, what do I do?
Right. No, this is good. Okay. So my other lesson is kind of similar to this, what we've been talking about, but it's to have some funny money on the side. And I feel like for me, I've been able to invest in some of the riskier things that might not be like what Warren Buffett would buy because it's in this smaller account on the side that's not my retirement. And if something blows up in there or the company doesn't do what I think it's going to do, I'm okay with that. Mm-hmm. And that makes investing fun for me. So a good example of that is, and I get asked this question a lot, I actually own some shares of FNKO in that account. And the ticker is FNKO. And they make these pop culture.
How appropriate for your funny money account.
Right, to be in FNKO, yeah. They make these pop culture, basically toys and like board games now. And it's a growth stock. It's been a little more expensive, but it's come down again. I've owned it for over a year now, I think. And it doesn't pay a dividend. It's a small cap. And now it's trading at 12 times. But I used to get asked, like, that's not a value stock, Tracey. But that's why it's in that funny money kind of account, because it isn't in my normal wheelhouse, because I do like to buy value. But I just happen to like the model of that company as well. And now that it's trading at like 12 times, now it is more in my wheelhouse. I'm looking at it again. Yeah. Maybe I'll add some more shares. But yeah, I feel like something I've learned over all the years is to have one of these smaller side accounts.
Mm-hmm. Yeah, and I kind of don't like when people call it funny money, because then it sort of implies, I could just
lose it,
like going to Vegas.
Yes.
Right? That's
it's
funny.
not total gambling.
Yeah, that's funny money when you go to Vegas, But this is more what you would call the opposite of risk averse. You have risk appetite, right? You're willing to take chances.
I'm going out of my comfort zone.
Yeah, exactly.
Some of those.
And so, in that sense, it can be fun and it can be educational, especially if it forces you to learn about companies.
Yeah.
If you enjoy that.
Okay, so now we're at your fourth, the ETFs.
Yeah, so I wanted to, even though I talked a lot about ETFs under the trends theme, I think ETFs needs to always be its own theme, so that people remember that you're looking at trends, and that can be a whole research project for you, what you see in the economy longer term and how technology is changing the world, whether we like it or not. But then ETFs are the vehicles, and you know, I just wrote down a note like, this is what I wanted to say. Making investment decisions can be hard. You know, even if you have a plan, you're going to reach junctures where, you know, you got people screaming at you that the recession is coming,
right?
Or that, some Democrat is going to raise the wealth tax to 90% or something,
and it's all going to crash.
Yeah.
I keep seeing that, like 50%.
Yeah, how many people? How many like Leon Cooperman and somebody else have said, "Oh, the stock market is going to drop 50%,
right?
If we get a socialist regime or something."
Right.
So all that noise can be confusing, and it makes your decisions harder. But ETFs are simple. Just like in March of 2009, when I said I am 100% confident to tell anybody that you can buy these two ETFs now, today, put them away, don't worry about them. So and ETFs do that for you because they're a basket of stocks. They don't have company-specific risk.
Right.
And
if one blows up in there, there's enough other ones not to blow up everything.
We have an ETF.
Hopefully.
We have an ETF portfolio here that is still managed by Nina, right?
We do.
Yes. Just making sure that, yes, Nina is still our
ETF investor.
Yeah, ETF investor. And I'm just looking at some of the big winners in here. Like in September of 2016, she went and bought an ETF for semiconductors.
Okay.
The iShares semiconductor ETF, symbol SOXX, and up 110% in 3 years.
Interesting.
Yeah. So, you know, that's the power of ETFs. And she went very specific here. I said buy XLK a long time ago, and you would still want to buy it on dips. She went deeper into tech, into an industry, semiconductors, and has done fantastic.
Isn't that the beauty of the ETFs? Is you can do these very niche areas.
Yes, there's tons. I mean, I'm just looking at her portfolio. She has... how many
does she own?
Oh my gosh, she might have 25 ETFs here.
Yeah.
So a lot of niches here.
Yeah.
And just looking at like the top 10, all have returns of 20% or greater.
Okay.
And she's got some lengthy holding periods here, 2016, 2017 in her top 10. So I'll just name one other. I think she's got a retail ETF.
Wow.
There might be a dividend payer or a real estate one in here.
Yeah.
And the other thing that ETFs do for you is they let you sleep at night. You don't have the company. You're not going to wake up and find out accounting fraud takes the stock down 50%.
Yes, we heard that. CEO fired.
Oh, they've got to restate earnings. Yeah. CEO leaves.
CEO sends out weird tweet.
Bad earnings report. You're never going to have the
Right.
20% down day.
Right. But you also don't get the other direction either, which some people like. They want to be able to find that lottery stock that sees the big, like the Biogen announcement.
So what I'm saying is you don't put all your money in ETFs, but you learn how to use them.
Yeah.
And from your own experience, you will learn that, wow, this has been a safe way to invest and grow my money over 5, 10 years or longer.
Yeah.
And, and especially if you dollar cost average into them, just like if you have a plan to say, I'm going to put this much money in this ETF every quarter.
Right. And you can do that now in most of the trading accounts. So that's easy.
And I want to say if I had 5 themes.
Okay.
My fifth.
Wait, there's a surprise fifth
one?
one?
My fifth theme would be I never talked about recession as part of this, right? Recession is not one of the themes.
So who cares? Who cares about any of that?
They happen, right?
They do.
Economic cycles happen, and the stock market will have its own cycle intertwined with the economic cycle.
I'm always reminded of certain companies that have been around forever, like a Sherwin-Williams. which does paint. And literally they've been in business, I didn't look it up, but at least 100 years, I want to say. And think about all the recessions and even a Great Depression and everything else, all the wars, assassination attempts, various presidents, political parties, everything in that amount of time. And they're still out there just doing their business.
And we're not saying that they're recession proof, because they certainly aren't.
Right. Nobody is.
Yeah, I just looked up the stock here. In 2016, it was trading like $225 you could have bought it for, and it's $563 now.
I know.
SHW.
I really wanted to buy it a couple of years ago, and I was like, I'm going to wait till it gets cheaper, and it never really has. So I still don't own that one. But I do like looking at these companies that have such a long history because they have been through basically everything. And in Sherwin-Williams' case, they've come out a winner in their industry. That's one of the ones. If you bought one of the winners, they ultimately...
And you do not own it, right?
I do not.
Yeah. So here's a good example of Tracey and I are not gloating over big winners.
No,
we don't have this one, and
I wish I did.
And there's an old saying that in a bull market, everyone looks like a genius,
right?
Because stocks go up. But you know what? There's been some trying times here. The market went sideways basically for a year and a half with a lot of volatility.
Yeah.
Semiconductors went way down, and then they've rocked up to new highs.
Yeah. And this is not a tech stock.
Right.
Sherwin-Williams.
So there's still homework to be done. The one of the big tailwinds, obviously, we can't ignore the elephant in the room, is the Federal Reserve. Monetary policy matters. So what you hear the old guys say is, don't fight the Fed. Well, clearly, monetary policy and liquidity are on the side of investors. And as the Fed has cut rates and will stay easy, because they want inflation. So this is still a good time to be an investor.
Yeah. There's always a good time to be an investor.
Exactly, yeah. Longer term, we don't even talk about recession. Right? And you're going to hear people on TV, talking about the 2020 recession. They've actually had to pipe down a little bit now.
They have. It's gone away.
Since we've broken out to new highs.
I know.
And the Fed is steady. So you're going to hear that again. It's going to come up. Maybe it gets delayed for a few months.
Soon we're going to hear the 2021.
Yeah, because of the election or something, right?
Right.
But if you're picking quality companies and you're buying ETFs with 5-year or 10-year money, it doesn't matter.
Right.
The noise doesn't matter. Block out the noise.
Yeah. Good advice. Well, thank you for being here on the 200th episode. And I hope you're here. I should have you back on for the 400th episode.
Sounds good.
Might be a number of years. You might have to be waiting, but this was fun. So yeah, let's recap the stocks and ETFs we talked about, because there were quite a few on this episode. So we had the tech ETF, the XLK, and we had the biotech ETF, IBB. We mentioned Amazon, AMZN. We mentioned Apple, AAPL. FNKO is FNKO. We mentioned Square, SQ, and Sherwin-Williams is SHW. And we had the SOXX ETF, SOXX, which is the semiconductors.
And I also mentioned NVIDIA.
Oh, yeah.
Because of their parallel processing chips, they're actually extending Moore's Law. Moore's Law sort of leveled off in the past few years. It's being reaccelerated because of just the computing power that they're getting out of this parallel processing chips.
Okay, that's NVDA, if you don't already know that one. And you want to be sure to subscribe so you get all of our future episodes, so you don't miss a single thing here at the Market Edge, because we're always bringing you whatever's happening on the stock market. And you can get us on Apple Podcasts. We are on Spotify and, of course, on SoundCloud. But be sure to get us someplace, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.